All right, well, we've got a dude from Cincinnati and a couple firefighters from near Chicago ready to get down and dirty here today, Josh. I'm excited.
Luke,
I don't know why Luke decides to waste his time with us. Like, and all the directions
just
he
we
gets
pester
pulled.
him. We pester him until he finally says, I got to get these guys off my back and get this over with, you know? We have to come up with a name for you, Luke. You got the Oracle of Omaha. We got to come up with something catchy for Cincinnati or Ohio.
Ohio, yeah, Cleveland, yeah. I don't know, nothing. You know,
wait, are you in Cleveland or are you in Cincy?
I went to Cincinnati. My oldest boy goes to Cincy, but I'm from Cleveland, so either one works. I'm from Cleveland. I root for the Browns, sadly, although not so sadly this year. But yeah,
we have the Bears. We're familiar.
Yeah. Oh yeah, you guys arguably you're trying to do the Browns imitation. You know, the first 99 Browns imitation.
It's pathetic. Being a Bears fan, being a Bears fan is pathetic. It's absolutely pathetic. You basically just get cucked as a sports fan over and over and over again. Like yesterday,
but you fall for it every year, right? And they're like, wait, we can just buy grabbing the cheapest players we can, and these idiots just keep showing up to the stadium.
You know that you root for a horrendous sports team when just absolutely tiny stimulus gets you excited. Like yesterday, I was watching the Bears. They have this dude that played Division II football, Bajent, who started yesterday because Fields was injured. I mean, his performance wasn't even impressive. He was just like completely average performance if you really zoomed out. But as a Bears fan, hope is suddenly injected, and you know you're about to be on the road to disappointment once again.
Dude, it's a perpetual bear market when you're a Bear fan. Perpetual.
You're talking to a Browns guy, so yeah, I'm glutton for punishment. So it's we'll see how the rest of this year goes for sure.
Luke, I want to ask you a question just about your life flow and vocation that I've thought about listening to you. It is so apparent reading, listening to your analysis that you just spend an abhorrent amount of time studying and researching. You're just all in, completely invested, which is part of the reason FFTT has been successful. My question is, do you ever get sick of it? You've been doing this for a long time, right? Nose to the grindstone sort of every week. I think last time you were on here, you described yourself as like a bottom-feeding catfish who just tries to just take in stuff. But you're just constantly inhaling this, distilling ideas. It's remarkable to pay attention to. But as a window into your life, does it ever exhaust you is question one. And then if so, how do you sort of work through that malaise, keep the motivation up and keep cranking?
So bigger picture, no, I don't get sick of it. Every day I wake up, I'm excited to learn and what's going on in the markets, etc. As this has gone on, it's like a lot of things, right? It's like the overnight 10-year success, which is, you paddling like crazy under the water like the duck while sort of streaming along calmly on the surface. It has required a much more focus on what I would call balance. In the last 2 or 3 years, maybe, I think as visibility has increased, as events have accelerated, macro, geopolitical, and really managing my energy around what I'm devoting energy to, because otherwise it can just physically drain you. And I was finding at times that was the case, right? I can feel if I'm on Twitter too much, I can start to physically feel it. And so that really becomes, there's a management process to that. And it's ongoing. It is, some days I could at the end of the day and be like, oh, I managed my energy terribly today. I managed my attention terribly. And some days I did it well. And then it's also listening to, hey, my body feels like death, or I need to sleep, and I'll sleep in. Like there are days where I'll sleep in to 8 or 8:30, and it's great. There are days when I wake up at 3:30 or 4 in the morning, and like something hits, and it's just like one of those things where, oh my gosh, it's a revelation. And I just know there's no going back to sleep. I have a pen and paper by my bed, and I'll roll over and write something down and get it out. That usually works, but there's sometimes where it's still going, and I just sort of quietly, slink off so as to not wake up Mrs. FFTT, and I go down and I'll start writing. And so it really is just, I think, acknowledging to work when the flow is there, but then also B, acknowledging and needing to manage this balance, because it's especially the last couple years, it's pretty until you start layering these wars in and things accelerating. Like it's, being on Twitter is kind of a drag right now. Like or being, reading the news, trying to stay up and informed. It's a drag. It's right.
What you just said about waking up and writing something down is so important in my mind. I do that not often, but when I do, I've often made the mistake of not writing down whatever it was I thought of, and then you try to remember that like during the next day. It's like a dream. You had it when you woke up,
vanishes.
And it just vanishes on you. And it's amazing the way that works. I don't know what's going on in our brains, but you can just completely forget a great idea.
Yeah.
I wanted to circle back to, we were talking just before we started the discussion about how we discovered you years ago in the gold forum. Like you have a big following from gold bugs, and that kind of lends itself to, people that transitioned or kind of still ride the fence between gold and Bitcoin. I'm pretty solid on your your thoughts on gold. And I think I understand the argument, and it makes tons of sense to me, and it has for quite a long time. But more and more recently, we're hearing the word Bitcoin out of you and a lot of other macro analysts. The question really is, where do you see gold and Bitcoin in the following 20 years? Do you think that gold is going to be just a barbarous relic, as the Oracle of Omaha likes to call it, or is it going to are we going to ride the fence between the two of these, or is Bitcoin going to be much more prominent in the next 10 to 20 years in your view versus gold?
Can make the case either. I think that, let me put it. I think there is going to be, unless there is some sort of energy productivity miracle, right? Where nuclear fusion, portable fission, these alien things we've been hearing about are A, real, B, we've reverse engineered something and we sort of get like free energy, some leap forward in terms of energy productivity. If something like that doesn't happen, then we have an economic problem of basically a global sovereign debt bubble bursting. You have too much, basically the amount of debt you have in the system, you need really low, you need negative real interest rates. And to drive the economic growth, to service the debt, you need increasingly more expensive oil in particular. That's not to say we're running out of it. It just means you can look around. I mean, this is not, it's just boom. The $2 oil is gone, then the $10 oil, then the 20, that's so on and so forth. Even now they're doing a bunch more deep sea drilling over the next 10 years. Great. That's like $50, $60 oil. That's like the minimum. So you need more and more expensive oil, which means there's this mismatch between low inflation here, high inflation here. That fundamental disconnect means that it's just a bad idea. Global sovereigns cannot save in debt. Basically, debt has to lose money relative to energy over the next 10, 20 years if we don't get an energy miracle, productivity miracle. So in that world, then you need a new neutral reserve asset. You need some other asset that you can save in that is going to sort of cut that Gordian knot between needing higher prices for energy and lower rates of inflation to keep the debt sustainable. From there is my view of it is that there's a pathway. I think gold sort of steps into that realm first, quite frankly, because the crisis is now.
Yeah.
And gold sits on central bank balance sheets, and they really don't want to use it. They don't want to do it, et cetera, et cetera. But we can see across the world for the past 10 years, global central banks have been adding to their gold reserves and not adding to their debt reserves. They've not been adding to their treasury reserves at the central bank level. And so I think gold sort of has its first step up at the central bank sovereign level. I think de facto we can see Bitcoin has been serving that role amongst the people, if you will. I think Bitcoin does a lot of things that gold does better than gold. And I like Bitcoin a lot. It has outperformed gold. Some of that is because of sort of the instruments that have been used to manage gold's price by the sovereigns to try to keep the existing system going. Have capped the price of gold in a way it hasn't really happened with Bitcoin for any number of reasons. So my view of it as it stands now, and this could change, is I think we see gold. I think we see both work. I think gold probably works and then probably has some sort of step function higher at some point in the midst of some debt crisis where it becomes mathematically obvious to everybody that they need. Basically, they need something on central bank balance sheets to eat a lot of debt, something that offsets a lot of debt that's there so they can delever instantly. And there's no Bitcoin on the balance sheet. There is gold. So they can write up the gold, write down debt to GDP, normalize policy, and go from there. And so I like them both. I think gold will be used first. Is it possible that this system falls apart and in their dogma, there being the central banker's dogma to just not use gold, that it falls apart on them and Bitcoin sort of de facto? Yeah, it's entirely possible. It's not my base case, but it's also, I'm allocated in a way that that would be okay. Like if we completely demonetize, if we go from here to gold being a lump of metal for decorative purposes and Bitcoin at whatever huge number, okay, I was wrong on my gold, and my allocation to Bitcoin is so much that I'm laughing. I'm using my gold as paperweights. I don't give a crap. So that's how I think about it. But I think over the next 10 years, it's this unless there's some energy miracle, the 40-year bond bull market is over on a real basis. Doesn't mean it can't, you can make money now, but on a real basis, bonds have to lose relative to energy.
Yeah. I like, Josh, that you started here. Luke, I mean, we're gonna in the latter part of this discussion, we're gonna spend a bunch of time talking about the bond market and the fiscal conundrum and the spiral and all that. But what we find in these conversations is that we end up talking so much macro that we barely touch Bitcoin at the end. So I like kind of starting here, and I think you make a couple of good points. One thing I push back on with Bitcoiners that think gold is completely useless and destined for imminent failure, I just think there's an overestimation of how quickly asset understanding changes. I mean, we are enamored with a lot of Bitcoin's properties. We're very bullish on where it's headed, but there's still really significant stigma. There's a massive knowledge gap. It is in many ways unproven, right? It's still very young and theoretical in its mission. I know that may trigger some people, but case in point, gold is sitting on sovereign balance sheets right now. Bitcoin, not so much. Okay. So I think there is a valid point to be made that if this system is going to blow up and spiral out of control the way you anticipate, and we largely agree, people are going to be clamoring for what you just mentioned, neutral reserve assets, right? Hard assets that can't be printed. And, societal understanding of what that represents, gold comes top of mind for most people right now, right? And until that sort of perception changes, right? Narratives matter. People's understanding of assets matter tremendously. And so to say that gold's not going to be part of the picture seems unbelievably naive to me. Here's my question. What sort of would tip the scales for you? So gold does seem to be your fiscal debt spiral hedge of choice, right? What would Bitcoin need to start accomplishing? What would you need to start hearing and seeing for you to say, you know what, maybe Bitcoin is going to be the main show here that eats a lot of this? What things are you looking for?
I mean, I think first and foremost, you'd want to see it show up in at a sovereign creditor, right? So There have been various rumors that Russia is mining Bitcoin. If for some reason we found out Russia, alongside all that gold that they've been accumulating over the last 15 years, hey, they're mining Bitcoin now. They've got rigs attached to Gazprom gas, and away we go. Or China doing something similarly in terms of converting dollar surpluses or what have you, or whatever, trading between Russia and settling in it. Something like that, even on an experimental basis, would, I think, be your first sort of highlight of that. Hearing Aramco is getting involved with some sort of mining operation or something like that, Bitcoin mining operation, something like that, or they're just going to divert one little gas field to one little, something like that, where I think they specifically don't do that because I think it's very powerful, right? It's the Bitcoin market relative to the global oil market alone, gas. But I think if you saw that's probably what I would be looking for first, is some sort of, and you've seen arguably from the U.S. some sort of open-mindedness about this in terms of Jason Lowry, his book Soft War, and it's brilliant. He's brilliant. He has kind of highlighted that. My understanding is that upon reading that, there's probably some people at the Pentagon that have read that, and in the intelligence community that have read that and understand that if push came to shove, a trump card the United States could play would be to say, in the midst of a crisis, okay, we are going to be settling in Bitcoin. If somebody else tries to weaponize gold against us, for example, if we don't have the gold, if we don't have 8,000 tons because it was used in secret ops over the last 40 years, as some people say, I don't believe that, but I would concede readily that it's entirely possible. Then in an emergency, that type. So you have seen the U.S. talk a bit about that. At least there has been some public. So I would need to see more of that before I sort of reordered that path from here to gold, and Bitcoin sort of more organically from a grassroots level, do what I think it's ultimately, what it has done, or I think what it's ultimately going to do.
Gotcha. You mentioned earlier, and there's a lot of contention. Joe Carlasari comes to mind when you talk about managing gold. We've heard for years the rumor that paper's used to push gold around potentially. Do you have could you explain how that could work to us on a very simplified level? And then how you think it is that could happen to Bitcoin? Could the ETF be used in that sort of way? Like, explain to us how paper can move the price of an asset like that. And then if that's a concern of yours moving forward with the ETF approval. Dan and I are paramedics. We see people day in and day out who have one major concern: insurance. They either have no insurance or they have some inadequate insurance that doesn't cover a thing while sticking them with a huge premium. They're worried about the cost of the ambulance and the hospital. Sometimes they refuse to be transported to the hospital for urgent needed care just because they don't have insurance. This is where CrowdHealth comes in. CrowdHealth is not health insurance. It's better. You contribute every month to a fund that covers you and assists other members in need. If you ever have a significant health issue, you can get crowdfunded. You pay the first $500 and then the community will step in to help you out. CrowdHealth will negotiate on your behalf to obtain the best price possible. If you're sick of overpriced and underperforming insurance companies, try CrowdHealth. Support humans, not giant healthcare corporations. You can try it starting at $99 per month for the first 6 months if you use code BLUE. That's code BLUE. Have you been paying attention the last few years? If so, you know one thing. Not your keys, not your coins. This is a quaint saying, but it's real. If you're not holding your seed keys, you have a Bitcoin IOU, not Bitcoin. CoinKite is the maker of the Cold Card Mark IV. This is the industry standard for holding the keys to your Bitcoin. Holding your keys should not be intimidating, and it isn't. The Mark IV makes this an incredibly simple process. You could be a degenerate firefighter and hold your own keys. That's how simple it is. If you want to create a more complex setup, the Cold Card Mark IV has you covered there as well. You can create a multi-sig using a cold card, a tap signer, and even the upcoming Q1. Speaking of the Q1, If you want to have every bell and whistle and give yourself no boundaries as far as interacting with Bitcoin is concerned, the Q1 is your signing device. CoinKite makes some of the most sought after gear in Bitcoin: the block clock, seed plates, the open dime, and the Sats card. Everything you need to secure your Bitcoin. Click on the link in our show notes to get discounts at the CoinKite store or use code BCB for 5% off the Mark IV.
So I think it's important to start when you're thinking about the ability to manipulate the price of something. You have to look at that something's stock to flow ratio. Okay. And the higher the stock to flow ratio, the easier it is to manipulate. The reason that is think about it this way. Gold has a stock to flow ratio, and stock to flow ratio is simply all the gold that was ever mined is your stock, and your flow ratio is the amount that's mined every year, mined or consumed. And so for gold, that number is roughly 60 or 65x stock to flow. By way of comparison, let's use oil, arguably the most valuable substance on the planet still. Oil, when oil's inventories are really high, the stock to flow ratio is maybe 1.2. And when they're really low, when you start to get concerned about shortages, they're like 1.1, 1.05. And we can see what happens when you have huge swings with a big paper market in a low stock to flow ratio asset. We saw it in April 2020 when oil prices went to negative 37.
Wild.
Oh shit, I own oil. I need to sell it. There's no place to put this stuff. Sell, right? So the way to think about the stock to flow ratio for purposes of manipulating the underlying is a shell game. And the stock to flow ratio is simply the number of shells per P. So if you have in oil, you cannot separate the P are the physical fundamentals. P is where supply demand is. And in oil, 1.1 to 1.2. Like you can't store the stuff everywhere. And if you're short, you're going to know because there's going to be gas lines. And so it's very difficult to separate, to use paper promises of oil, to separate the supply demand of oil for very long. The physical market will just, there's not enough shells to hide the P. In contrast, in gold, 60 shells, 60x stock to flow. There's 60 shells for every P because you're not consuming the gold. And by the way, a high stock to flow ratio is just, that's money. It's money like substance. It's an asset of a store of value asset. So with gold having such a high stock to flow ratio, it's been very easy. You create unallocated paper gold, right? So that's the big one centered in London. There's gold futures, and gold futures do create volatility, but ultimately in every future, there's a buyer, there's a seller. So it's the purists, and I think the purists are largely right in this case, is the real way you manipulate gold, right? So you're going to have mines, the physical. You're going to have unallocated paper, right? So you go to London, you say, hey, I want to buy 100 million in gold. I say, done. And 100 million in gold, that's simply credit gold. That is a bullion bank in London crediting their gold account, their short gold, boom, then they go out and buy gold futures, and sort of where the unallocated market intersects with the futures, right? So it is, that's why I say the purists are technically right, but it's, at any rate, let's keep it simple. They promise you 100 million in gold. Great. And as long as you never need it, which you probably aren't, what happens is there's been no, and in fact, if you've been paying attention for the last 20, 30 years, the fact that the regulators have allowed this expansion of unallocated gold, right? 100 million, done, 100 million, done. So now there's, a billion, there's 100 ounces outstanding for every ounce. And it's a very centralized pile of gold, as a lot of Bitcoiners have pointed out. And it's a very fair, and it's controlled by a small number of people. And that number of people holding gold has gotten much more centralized over the last 20 years with the ETFs, etc. That's a very fair criticism. So that is ultimately the issue. How you can do it.
I mean, I think a lot of proponents of Bitcoin would say like, well, that's the centralized issue with gold, right? And Bitcoin doesn't have that issue. But where that issue is reintroduced is with these ETFs that are you can't take possession from. You buy the BlackRock ETF potentially, and there's no delivery option. You can't just say, you know what, I'll just decide to take delivery of my Bitcoin instead of having you hold it. They don't give you the option. So now they have created this centralized hub where they don't necessarily have to prove they have the Bitcoin, and you can't take possession of it. So now it can be rehypothecated, and that's where the issue rises. Is that correct?
Without knowing chapter and verse on the ETF and all of those constructs, conceptually, yes, in essence, that is a potential problem. Now, how do they get people to give up their ETF or their Bitcoin to a centralized ETF? Like, we can sort of look back to the GLD, right? They let, gold went from 250 or 300 when I guess GLD came out in November of 04, maybe we'll say. And it, it was probably $400, and it ran to 1,000 by 08, early 08, kind of pulled back in the great financial crisis, and then ran to 2,000. All along, hey, look at the assets in GLD, rising. And that, so my point is from a tactical standpoint, and even sort of secularly for a while, the only way you're going to get that fund to draw the assets in is by letting the spot price run for a while. And then at some point down the road, they can use that to control it. Now, couple things that are different, of course, with Bitcoin is, you still have the decentralized nodes verification, right, in a way that is much different than gold. Number two, unlike buying physical gold, which is like a pain in the ass, and most people still don't know how to do it, particularly for the younger generations, it's actually easier to buy physical Bitcoin than it is to buy physical gold, right? It's like it's a lot easier to buy GLD ETF, right? If I have a brokerage account and I want to own gold, it's way easier to buy GLD ETF, or if I'm a future or an institution, it's easier to buy gold futures than it is to actually buy the physical and take delivery. That is not true for the average retail investor for Bitcoin, particularly, I don't know, draw an arbitrary line, say age 35 and below, people that are very comfortable with phones and with technology and sort of like, I don't think that's true. It's a lot easier to get on Coinbase or on, Swan Bitcoin or whatever, and just say boom, boom, and then cold store it. So that's the thing that is very different to that sort of ETF, hey, let's suck up all of the physical supply and then let's expand the unallocated derivatives and we'll use it. That I think is probably the model that some of the, the powers that be are looking at, but there are some areas where that model breaks down. So, let's see how it plays out.
I think a lot of good points made there. I think, we have talked some recently about the concerns. Actually, our last episode, we talked about the ETF quite a bit, and basically the potential perils of somebody else, quote unquote, hodling your Bitcoin, right? Because although a hardcore Bitcoiner would say, it's self-custody or bust, a lot of people are going to be buying these funds. Some intermediary is going to be storing them, and they're not going to be using their Bitcoin. Back to your point, right? This is the main value proposition, at least for big money right now, isn't to move this thing around or buy things with it. It's to sit on it, right? And so that is, if somebody else is, accumulating it and then it's just sitting there, that presents from a first principles basis all these opportunities for manipulation. I think some of the points you brought up, though, that are very fair and worth noting on the bullish side of Bitcoin is we do have a level of transparency on this ledger that is totally unparalleled in human history. Right. There are so many different sets of eyes with so many different incentives staring at this thing. And so I think, if you do play those manipulation games, they may work for a period of time, but if you zoom out over years, I think it's going to be really hard to pull that off. And like you said, the frictions of self-custody are increasingly well lubricated, especially for a young generation that knows their way around this stuff. It's pretty simple. I mean, most Bitcoiners have walked through it. It may seem intimidating to a boomer, but it really is. You hop on YouTube, see a video, buy a hardware wallet. It's not all that hard. So there is the ability to call a bluff on this centralizing force in a way that hasn't existed before, which it is really powerful.
And you know what's really a turnoff to Zoomers or anyone in the younger generation when it comes to gold? When you bring a box of gold coins to the post office and send it off to New York to get, that is not a situation that feels good at all. I had a box of like a decent amount of gold coins that I sent off to Kidco, like, I don't know, like 7 or 8 years ago, and they got lost in the mail.
Oh no!
Your Bitcoin's not going to get lost coming to you in your cold storage.
Well, unless you send the wrong, you can send it to the wrong address.
Well, that's true, but you double check that, and you don't have to depend on somebody else to, oops, I lost this box. It's in the back of a, I figured out there were gold coins in it and I stole them.
Yeah, I think this goes back to the topic we were discussing earlier about assets that are going to be in high demand. Society needs to decide that, right? The collective consciousness of society and markets decides what's in high demand. And especially in a date and time where things are moving this quickly from a technological standpoint, you really could see the window flip, right? Bitcoin goes from unknown, complex, overwhelming to the most obvious, easy choice for a new generation. And that could happen in a fairly short order. I'm not talking 1 year, but let's just play out, sovereign debt unwind, gold and Bitcoin kind of participating, and then a new generation going, why are we dealing with this yellow rock when this digital thing works better? I think the main high level point here is, why not play both sides of the fiddle here? You made the point earlier. Yeah. If these things are going to go up at the levels that they have the potential to, it's not going to require a huge allocation of either to be safe in an environment that's really precarious.
That's where I really come down on it, because I think it's important to look at sort of, the level of sort of a that you were just describing, right? In terms of the population getting a degree of comfort with Bitcoin faster than people anticipate. That is, I would let's just call it broadly retail. It's an oversimplification, but that's retail. And that's important. It's potentially really important. It's almost revolutionary. But ultimately, at least in the near term, in my view, it doesn't matter. And why I say that is it's the giants that matter, right? It is, what does Russia want? What do oil exporting, let me put it back up. Oil exporting United States creditors with nuclear weapons and oil importing U.S. creditors with nuclear weapons. What do they want? And what are they doing? And those are what I would call the giants. And these two, it doesn't necessarily mean that these can't overtake that. There can't be sort of a popular revolution, if you will. That's entirely possible, particularly if the West continues to drag its feet by capping gold, right? If the West keeps capping gold while Russia and China keep buying up gold, and gold doesn't go anywhere, then the U.S. retail community is never going to buy gold, which is in the short run smart for the policymakers, but in the long run stupid, because what it means is, to go back to the stock to flow ratio, the way you get gold to rise in value is you collapse the stock to flow ratio. So if you go from 60 to 1, the price of gold, one of two things has to happen. Either you have to increase your unallocated gold promises, your derivatives, by 60x or 59x. And even then, it'll only work for a little, because you're going to run out of the physical. Or you got to let the price of gold run like unbelievably. And so, okay, how do you get it go from 60x to 1x? Well, the stock to flow ratio of oil is 1, 1.2, whatever. Stock to flow of gold is 60. If Russia and China agree that we're going to settle net oil imbalances in gold, and de facto, that's what they're doing. Like, this isn't hypothetical. Like, if you look at it, that's what's happening. Small, but that's what's happening. Then de facto, the price of the stock to flow ratio of gold starts to go from 60 towards 1. It starts to go to oil because gold and oil become fungible. And at that point, either this is the late 60s, early 70s all over again. You lose physical, you lose physical, you lose physical, and then you say no mas, and then the price of gold goes like crazy. And what are we seeing right now? London, New York, losing gold, losing gold, losing gold. Where's it going? East. What's happening in oil? Oil is priced in yuan. There's just a headline someone sent to me earlier this morning. 95% of the trade between Russia and China is being done in yuan and rubles. Oh, who cares? Russia's only I don't know. They've got the GDP of Italy or Portugal. Who cares? They're also 17% of the oil export market. Yeah. 17%. That's more than enough. That will force, it's just a matter of time. Gold will move towards oil stock to flow ratio. So that's sort of it's this retail, I think, is inexorable. It's going to happen over time. The giants, there's two different sides, right? There's what we want, and we spend a lot of time, we collectively here in the West, what do we want? And there's not as much time really spent around what are the Russians' goals, what are the Chinese goals in what they're doing beyond, Putin bad, Xi bad, dictator, autocrat, blah, blah, blah. And some of those things are probably true in some level. I don't care. I just want to know, I'm not Chinese. I don't live there. I want to know what their motivations are. And their motivations are their systems will collapse if they don't shift to reserving in some sort of neutral reserve asset, if they don't shift to being able to buy and transact in their own currencies. And we're watching it happen.
Yeah. Yeah, they're hitched to a ship that they're fully aware is headed underwater. And they're going to try to weasel their way out of these chains for sure. To switch gears slightly and to make this, I want to start kind of high level and basic. You and we talk all the time about what we know is an extremely concerning sovereign debt situation. And I guess I want to make a comment right off the bat. I know that some people, maybe especially in Bitcoin, are like, "Oh, I've heard so much talk about the debt and debt loads and all this stuff." Well, folks, it really is the headline of our time economically, right? And first of all, these things don't play out in 4 months. So you're going to hear about this over a long period of time because this really is quite obviously the theme of the decade or beyond. It's a huge problem that does need fixing. Let's distill this down to real people. These are you, me, households, folks, all that are trapped in an environment that is really concerning and needs some form of restitution. And whether it's painful or not is going to happen. Here's my question. If you were to talk to somebody that's kind of just entering this conversation and is unaware of these problems, how did we get here, Luke? How are we at this concerning of an environment fiscally and from a sovereign debt perspective? What happened? Go back as far as you want and catch us up on how the shit show is this crazy at this point.
Where back do we want to go? I think ultimately it's the same story. I would encourage listeners to go buy the book Price of Time by Edward Chancellor and read it.
It's amazing. I read it.
And it's the same.
We'll link that.
It's the same crap over and over and over and over. It's human nature, which is greed and fear, and trying to allocate resources via economics, etc. So ultimately, we end of World War II, we set up a system where dollar's the center of the system, tied to gold at 35 an ounce. Everyone else is tied to us. We do a lot of consuming to try to help people get back on their feet after the war. Pretty soon, by nature, these, the Japanese, the Germans in particular, are very productive economically, and they begin to outcompete us. Full stop. That's all it is. They outcompete us. And so now they want to, under the terms of the system, they're supposed to be allowed to settle in gold at 35 an ounce. And while they're outcompeting us economically, we are also doing dumb things politically. We are doing things as if there are no costs to them. guns and butter, right? So Vietnam, galactically stupid, based on a view that, we need to contain the Soviets. And maybe that was the right thing to do. It's very hard to argue the counterfactual, once you kind of get to 89. So we run these deficits, they start wanting the gold, and then so we change the rules. You can't have the gold. We close the gold window. First, we revalue from 35 to 42. Then the London gold pool breaks down, and then Nixon just closes the gold window and changes the rules. Part of the rule change was basically setting up the petrodollar system, where in a way basically the dollar was kept as good as gold for oil. In other words, a treasury bond held its value in oil at a range from 73 to 03 for almost 30 years. Oil traded between basically $15 and $25 a barrel, which is incredible. I mean, it was basically an oil standard. And then that broke down. Same reasons as always is, we sort of, some of it is growth, and it's not all bad things, it's not all dumb things. There's a share of dumb things. There's also, growth. When growth moves non-linearly with technology versus, sort of this underlying system, it creates these strains. So you go back, 2000, we have a stock bubble. It bursts. We kick it upstairs to the housing system, to the banking system by creating a housing bubble. It bursts. We kick it upstairs to the sovereign debt level by backstopping everything. And now this global sovereign debt bubble is bursting, like they have throughout history. If you read, Price of Time, and there's one last bubble to have, which is the fiat currency bubble, which is we're coming to a head. There is an interest rate where the United States government, the most powerful nation in the history of the world, cannot afford its interest, its defense, and its entitlements. And we're actually already there. Like we can't pay those three out of tax receipts now. Part of the reason people don't see it is because of how the system is structured with 13 trillion in offshore debt, the Eurodollar system. If the U.S. decides not to print the money for those three big things, which are bigger than their receipts by 10, 15% already, it paradoxically drives the dollar up. It starts crowding out the world and the dollar goes up. So people, I hear all the time, the dollar's going up, so we have nothing to worry about. I'm like, the dollar going up means you should be scared shitless.
Yes.
Because the more the dollar goes up, it creates a greater squeeze around the world, and they own all of our assets, and it creates this feedback. Ultimately, this comes down to the same thing that's happened for thousands of years. Again, in Price of Time is they have to default or restructure the debt, or they have to print the money. That's it.
Yeah. And
default or restructure the debt is, hey, 70 million boomers, you guys are rich enough, you have 30 trillion in assets, we're slashing entitlements by 60%. Defense, I know Israel, Ukraine, blah, blah, Taiwan, blah, blah, blah. Sorry. The budget's cut by 60%. Or we cut rates. That's it. And there's a lot of gnashing of teeth and discussing and a lot of ink spill. It's noise. At the end of the day, it's noise.
Yep.
Print or default. And we're there.
Yeah, that also reminds me of Changing World Order by Dalio. I haven't read The Price of Time. That's on my list, but he goes through, the rise and fall of empires over the last 500 years. And it, just as you enumerated there, it's the same old story every single time. It's the human nature of being able to print money, and eventually you blow yourself up. One thing I really appreciate about your perspective on all this, though, is how you tie energy back in with everything. And I don't think most people really appreciated how important energy was until the Ukraine situation happened, and, oil supply and all of that. It was a combination of COVID and Ukraine that really set light bulbs off around the world as far as energy's importance. You talked on another podcast recently about how, Saudi Arabia is a good example. You talked about how we transitioned from gold to the petrodollar, and now this transition from the petrodollar seems to be happening. And the reason for that, in a very simplified way, is that Saudi Arabia traditionally has traded their oil for treasuries. At the moment, treasuries are, even though they're reaping some pretty decent interest rates on their face at the moment, they're still negative in a lot of ways. And you're losing money by sitting on a lot of these as their rates go up. So Saudi Arabia is trading real energy, barrels of oil, for treasuries that are losing value. It's a bad trade, and it might be better for them to just leave these things in the ground, or alternatively, find another partner, Russia, China, who are willing to trade in something more valuable. Talk a little bit about those dynamics, and just explain why this energy and gold, potentially Bitcoin tie-in, is so important, or basically for something of value, of commensurate value, to be traded for energy.
Yeah, so it's one of these things where if you asked a fish to describe its environment, the very last thing it would list would be the water, right? So we don't think about energy, particularly in America, we don't think about energy because since 1971 or 73, we literally have been able to print dollars for oil. That's the deal.
Yeah.
It's great. And so like my wife drives a 7,000-pound truck. Why? Because gas is $3 a gallon. And it's been $3 a gallon for a long time. If when I go to London and I people say, hey, how big a car, how big's your wife's car, right? That's because I'm American, right? American, Midwest American. And so like the stereotype of Midwestern Americans in England is like, we drive these big honking trucks. And it's like, well, stereotypes happen.
Well, you need
to
put on at least 150 pounds to hit that stereotype, Gromen.
Yeah. Luke, you got to look in the back parking lot of a fire station too. The pickups galore, all backed in, mostly for no reason. No, not many tradesmen on the side, just because they can.
That's right. Exactly. So
I might need to move something from Home Depot, Dan.
Right. Yeah, you got to put the kids' baseball team in there during the homecoming parade once in July, once a year. But what people particularly in the West, but particularly in America, as a result, miss is that energy is the base layer to currency. Energy is the base layer to our system. Implied or built into the valuation of every asset on the board, with the exception of gold and sort of Bitcoin, but we'll set those aside for a second. With the exception of gold for sure, is cheap and rising supplies of cheap oil. Plentiful and rising supplies of cheap and cheaper oil. Why do I say that? Think about, the average house in America. Has a valuation in the outer ring suburbs. The average city in America has no public transportation to speak of. The valuation of that house is based on gasoline being cheap. You take gasoline to $12 a gallon, what happens to the value of the houses in the outer ring suburbs across basically every suburb in America? They collapse, the housing values. What happens to the value of the mortgage bonds on those houses? They collapse. What happens to the banks that hold the mortgage bonds, or the government that holds the mortgage bonds? They collapse. The pensions, they collapse. What happens to the value of Amazon.com and the 70% of goods and consumption in this country that are moved via heavy-duty truck on a just-in-time basis? If gasoline goes to $10 or $12 or $15 a gallon, it all reorders down. Gas or oil is nature's discount rate. Energy is nature's discount rate. So if something changes fundamentally with the energy supply situation, if oil starts to structurally get more expensive, that changes everything. Everything we all know about the asset markets over the last 40 years is wrong. Because it's, again, at a retail level, you can see, every asset in America other than gold and Bitcoin to a degree have an implied energy base layer to them. Cheap and cheaper, more and more. What happens if it gets more and more expensive or gets less and less? Oof, okay. Flip side of the opposite side of the same coin goes back to these giants, right? And in particular, OPEC, Russia. OPEC and Russia, the oil exporting creditors of the U.S. If the geology of oil is such that it's going to cost more and more to get the marginal barrel to support the debt that exists, which is now massive by virtue of kicking the problems upstairs for as long as we have, they suddenly have that decision to make, which is, I can sell my oil, get dollars, put the dollars in bonds, treasury bonds, mortgage backs, whatever. And the fact is that the geology of such means that in 10 years, those bonds at these interest rates are going to buy me half of the oil that I'm selling today.
Yes.
That's a stupid trade. That's the kind of trade that gets you overthrown, killed, deposed in those places. The flip side is, okay, America, give me the interest rate that keeps me whole. In other words, oil is going to go up 7-8% per year on average over 10 years based on the geology, which you can kind of see, right? I mean, OPEC, they're coming out there saying we need to spend $23 trillion to keep oil production, sort of where it is over the next 10 years, right? That's a lot of capital. It's a lot of price impulse. America says, okay, what's that interest rate? And you can make any kind of assumptions, but it ain't 4, it ain't 5, it's probably 7, 8, 10. Okay, let's apply 7 or 8% rates to America's debt load secularly. Like now it's no longer America can't afford defense, entitlements, and interest without the Fed printing the money out of tax receipts. Now we're getting scary close to America having to print the interest on the debt alone. And when a nation has to print the interest on the debt, they have a word for it. It's called hyperinflation. That's it.
Yeah.
Currency system's done. So that is the sort of supergiant decision being looked at by the oil importing creditors or the oil exporting creditors. And in particularly after the 2000s, realpolitik here, you got to have nukes to enforce that, right? Like Saddam tried it. Saddam's no longer with us. And so, Putin has been trying it.
Gaddafi tried too.
Yeah, he did.
He's
and
sadly no longer with us either.
No longer with us either. These aren't, these are these are realpolitik harsh issues. So that's why I say you have to be nuclear armed. The flip side of that coin is the oil importing creditors, right? So if you're China and you sell a bunch of stuff to America and you take in dollar bonds and you hold a dollar bonds, you need to spend those dollar bonds to buy oil. So do the Japanese to import energy. Well, if the price of energy is going to go up, you're going to run out of dollar bonds. And when you run out of dollar bonds, your currency is going to collapse. That's not a mystery. The Chinese and the Japanese had a front row seat for it in 1997, 98, in Indonesia and Thailand, et cetera. It's the Southeast Asia crisis, South Korea. That is, again, politically unacceptable, particularly in China, which is not I'll be gentle here, a political ally of the United States like Japan is. We're providing Japan's defense, so there's some give and take there. People say China is the next Japan. Tell me how many military bases there are. Compare the two, Japan, China. Lots, 0. So China can't abide this either. It makes no sense for them to store their reserves in treasuries, in bonds. So that's where the energy side is coming in, is unless you get that energy productivity miracle that I've talked about, there's this fundamental mismatch between what the U.S. needs for an interest rate to finance itself and what the rest of the world needs to sort of to not end up having given away their oil and getting back dollars that buys them half the amount of oil when their oil production peaks in 5 years, 10 years, 20 years, whatever. It's just a bad trade. So that's the fundamental dynamic, the fundamental mismatch there.
Have you had the intention to mine Bitcoin, but thought that the equipment is too expensive or that running your own miner might be a bit too technical? Maybe you thought it would be cool, but the cost of electricity where you live makes it pointless. With HeatBit, you can kill 3 birds with 1 stone. It's a Bitcoin miner, a heater, and an air purifier all in one. It's a plug-and-play device that could not be simpler to operate. It has the latest 5nm chips to make it one of the most efficient Bitcoin miners in the world. On average, the HeatBit Mini pays for 70% of the electricity it uses. The HeatBit Mini also operates quietly. Good luck selling the idea to your wife that you're going to plug in Bitcoin miners in your basement that operate at the volume of a lawnmower. Not going to happen. HeatBit operates silently while keeping your significant other warm and cozy. HeatBit cares about your marriage. So, if you want to mine Bitcoin and remain married, Order a HeatBit Mini and keep warm while it pays for its own electricity bill. Visit heatbit.com and use code BCB for 5% off a HeatBit Mini.
Talk energy, I just go back to this high-level thought of real meets fake. Okay? We're in an environment where real and fake are more intertwined than they've ever been, right? If you have the real, you don't want to take the fake. All right. And when we think about monetary tools, gold, treasuries, Bitcoin, these are just abstractions on top of the real. And this is why I love when you go back to the base layer of energy, right? And so as the current system is becoming more and more fluffy and fake, those that have the real are going to look for abstractions that best reflect the real, right? And so that a lot of this is coming to a head, and it's increasingly obvious that U.S. treasuries aren't going to move in the direction of more sound and reflective of the real. This is where you get into the mathematical, monetary policy straitjacket of they have to be, liquidity has to be inserted, so really no matter what direction you look. Which I guess to transition that into a question, can you briefly, you've done this a few times recently on shows where you basically just walk through the order, right? The options and the order of how the spiral goes. Can you do that for us again? Just walk through the basic steps of why we're trapped in a valley and there's only one way out, and that's up and out.
Yeah. So, I mean, the system has basically been, we give, we give away our industrial base and middle class. They take it, China, Japan, foreign creditors take the base, they make stuff, they send us the stuff, we send them the dollars, they send the dollars back in terms of reinvesting into treasuries and U.S. financial markets. And for a while, it was a virtuous cycle. It's basically a vendor financing scheme, and it has its flaws. It had its flaws, but it's no longer working for a number of reasons. Number one, China has decided. I think the fundamental issue is oil's getting more expensive. The energy side of it doesn't work anymore. For the reasons we just highlighted. So now you're in this system where we send the dollars there. They are diversifying into other things, right? They are buying up things that better preserve real value. Equities, ports, oil, gold, weapons, all kinds of different things. The challenge in this, the way it's all set up, is by virtue of how the system worked, we ran deficits, they ran surpluses, they reinvested the surpluses here. That's the vendor financing scheme. They now have a net international investment position of 65, 70% of GDP relative to us. We have a negative net international investment position of negative 65% of GDP, which means foreigners own $18 trillion more in dollar assets net than we own of theirs. At the same time, again, by virtue of how this system has expanded with the Eurodollar system, offshore dollar debt, they're also short. They've also borrowed in offshore dollar markets $13 trillion. So they're short 13 trillion, they're long 18 trillion net. And once the US, that fundamental mismatch I highlighted, right, the US can't afford defense entitlements and interest out of receipts. If the Fed doesn't print the money to finance the difference, they squeeze the dollar higher, right? They're crowding out global dollar to finance those big three and everything else they do that the US government spends money on. So as the dollar gets squeezed higher, it squeezes the effective servicing in foreign currency terms of the 13 trillion in debt. What do? Oh, we need dollars. Well, we've got an $18 trillion pile of dollars over here. Oh, great. What's that denominated of? Well, it's 7.6 trillion in treasuries and call it 11 trillion in equities and sort of everything else. Well, what can we sell most easily? Treasuries. Okay, sell those and get the dollars, and then so there's really no brakes on this. The higher the dollar goes, the more pressure there is on the dollar borrowings. Now, it's not evenly distributed either, by the way. It's, China has a bunch of it, Japan has a bunch of it, Germany has a bunch of it. some of the weaker players, the Turkeys, the Argentinas of the world, they don't have a lot of dollar assets, whatever. So the game, it's not an evenly distributed unwind, but that's the unwind, and it will keep happening. And then it also, by the way, incents, and you've seen this even in the last 3 months, right? Argentina's basically out of dollar reserves. And then the Chinese show up and say, "Hey, we'll lend the yuan to you. Here's some yuan swap lines. You owe the IMF. Here, take these yuan, and you can pay the IMF." And so it's kind of been funny to watch. People say, "No one's going to take yuan." The friggin' IMF took yuan. The Argentinians turned around and said, "Here you go." And the IMF said, "Okay," which they have to because it's in their basket of currencies. And that can, so they basically, what I'm saying here is the more this goes on, the more it incents the de-dollarization of global commodity markets, because the more people run out of dollars when faced with, hey, collapse or the Chinese with a checkbook, they're going to go with the Chinese with a checkbook. Because, oh, by the way, the Chinese are basically everybody's biggest trading partner anyway. So it's like, all right. So it's there's, and paradoxically, that will only drive the dollar higher and accelerate this whole thing. And so I think when you look at sort of how the breakdown of this system unwinds, two things. Number one, the strong dollar, hey, we're winning mentality is wrong. It's we're winning against Argentina and winning it. It's not as clear that we're winning against others, China, right? The fact that U.S. banks broke before China, the fact that the gilt market broke before China tells you it's not so black and white. Oh, dollar up, we're winning against everybody. That's not right. But then secondly, it's very, very nonlinear. The faster it goes, the faster it goes. And so there's a lead time here that I don't think people appreciate of how quickly it could go.
Yeah. I was thinking about the way so we basically traded middle class over to China for, for a lot of the financialization benefits here in this country, hollowed out the middle class, traded it over there. And then they're turning around, stopping the buying of treasuries for the most part, and now buying up real assets in the United States and whether or not they planned this, I'm curious your thoughts on it, but they have a situation where no one wants to trust the Chinese Communist Party. No one wants to put significant funds into China, but they can use our free and open markets and our rule of law against us in a way by, being able to buy up the assets that matter here. But they have the caveat that because they don't have real rule of law, people don't really, they can't be the center of the financial world until they do. How do you think that kind of will play itself out, or if it will? Because there's so many people like Ray Dalio who think that China is on the rise and they are going to kind of financially take the world eventually. But without that transition to rule of law, being a dictator doesn't really draw anyone's money or funds to you. How do you think that? Do you think that transition is a possibility? And then can that be done without a decentralized currency, a la gold or Bitcoin?
I don't think it can be done without a decentralized neutral reserve asset like gold or Bitcoin. And I think you go back to 2015, PBOC officials were saying that we're going to internationalize the yuan. We're going to use gold to internationalize the yuan. And the mark of an internationalized currency is the ability to invoice oil and gas in your own currency. And so I guess 2015 at the LBMA conference, where they're telling you we're going to use gold to gain the ability to print yuan for oil, because on some level they understand that people don't trust the CCP and they don't want. I had this discussion yesterday on Twitter. They don't want the system as it existed for the last 50 years. Like that's the argument that China is going to overtake the dollar system and the yuan is going to replace the dollar as the dollar system has existed for the last 50 years is a straw man argument. It's not going to happen, and it's not even what they want, because that would require them to hollow out their manufacturing. And again, where it's there's nowhere that is big enough to be able to do that at the moment. What they're going to do, someone said to me the other day on Twitter, was, I said, as long as they can buy oil and gold and they're offering free flow in and out oil and gold, which they are, not in large volumes yet, but China's capital account is open through gold. It is also open through oil. You can take profits earned in yuan oil out in any currency you like. You can take gold out of the Shanghai Gold International Exchange. You can take it out of Hong Kong. It is convertible. The capital account is open through gold. It's not a big number, partly because gold has not been allowed to be made big enough to serve that role by virtue of how gold has been managed for the past 40, 50 years by the West. So the way we think about the world is we run the deficits to supply the currency for the global economy to work. And that's, we run up this debt, and unless the Chinese are willing to do that, they can't sort of do what they're achieving or aiming to do, and neither can the Russians. Or I think, and why I think it's a straw man argument is that's not what China's trying to do. And they've been saying this for 10 years. That's not the goal. So the question I was asked, and it's a great question, was, well, how is a foreign trading partner of China going to get the yuan in their hands if the Chinese aren't going to run the deficits in yuan terms? And that is where the gold comes in, right? So first, take a step back. Who runs a deficit against the Chinese? Or who runs a surplus against the Chinese? So who do the Chinese run a deficit right now? Nobody. It's OPEC, maybe Russia sometimes, and every now and then South Korea. Everybody else runs a deficit, right? So when you think about inflows, outflows, if China's not running the deficit, there's no yuan going out, except to oil producers and sometimes the South Koreans. Okay, so what's the rest of the world going to use to get yuan? Gold or oil. You sell your gold, you go buy gold, you take it to China, you sell it, guess what you get for your gold? Yuan. Now you've got yuan. And so I think ultimately there's this fundamental, we're trying to apply the Western model the last 50 years. And by the way, this was the Western model for the prior 200 years, before the last 50 years. Just we're sort of regimented in our thinking of like, oh, this is how all systems have to work. It's the most backward system ever. We're going to run all these deficits forever. China's not going to run deficits forever. They're going back to sort of the way the world worked for most of recorded economic history. People say, well, gold's not big enough to do that. No, not yet, but it will. And people say, well, there'll be a war before that happens. I'll be like, look around. These things aren't happening because we don't like Putin, because he's a gangster, because she's a gangster. Like, they're all gangsters on some level, right? These tensions are manifestations of a fundamental disagreement about the future direction of the global economic system, right? The rules-based global. China's not playing by the rules-based global order. Russia's not playing by the rules-based global order. Well, clearly the rules-based global order is not, you can't invade another country without cause, because we did that 20 years ago. So we didn't play by the rules-based global. So that's not the part of the rules-based global order so what is it? This is what I think it is they want to shift the system sort of back to the future, which is, you want to buy something in yuan? Go buy gold and bring us the gold, and then we'll sell it to you in yuan. This is, oh, by the way, something very sort of mechanically similar as happened in the late 1800s, right? With the beginning of the Chinese century of humiliation, where, the Brits went over to the Chinese and said, by the way, the Chinese have been like the most dominant culture for like 500 or 800 years up to that point. And the Brits said, we want to trade with you. And the Chinese said, hey, great. And so there's a whole bunch of tea and silk going to Britain. And the British are like, hey, we'll give you, what do you want? And the Chinese are like, silver. And at first they said, okay. And then the Chinese were so productive, they cleaned the Brits out of silver. And the Brits were like, well, that's not good. And so ultimately they had to find something else to sort of balance the trade. What they use opium. And and then there was a war. And then the Brits took Hong Kong as a prize to that war. And then, that was the beginning of the century of humiliation. So there's some things that are right. And that's a gross oversimplification of that whole situation. But I do that because it's important to kind of look at the trade flows of what China wants versus sort of what we're used to over the last 40, 50 years. And there's some things that are there's some history that's rhyming. And I think that looking at using gold, looking at using oil and commodities to do this, to arrive at the yuan, to supply the yuan to the world.
Yeah, so many good points. I think that is a huge misconception that we're just going to move from this system to another system that looks like it with another fiat currency at the helm. And it seems so obvious to us, at least from the seats we sit in, that we are watching the contractions of a new monetary order being birthed. Like there is a desperate demand. And this is kind of like the high level theme we've been hitting over and over in this conversation that can't be said enough. The world is desperately thirsty for a neutral reserve asset. And it's hard to picture how it's not going to happen. While you were talking, I just thought of a chapter from Lynn Alden's new book, Broken Money. She says, it's not as though the Eurozone or China can replace the United States as the issuer of a dominant world reserve currency. Neither of those currency blocks have 40% global GDP like the US once had. The Eurozone has a monetary union without fiscal union, insufficient energy security, and top-heavy demographics. China also has top-heavy demographics, weaker geography in terms of coasts and rivers and safe borders, weaker rule of law, and shallower capital markets. And then she goes on to just basically say, the world is shifting more multipolar, neutral reserve currency system rather than a system where one country issues far and away the most dominant world reserve currencies. That's just not realistic. That's not what we're moving into. And my other comment there, and I think this is near and dear to our demographic too, is USD hegemony. The negatives of USD hegemony are becoming more and more apparent. Right. If I was to oversimplify, I would say on the front half of this experiment that's not going well, you saw a lot of that exorbitant privilege. And now you're seeing more and more of that exorbitant disadvantage of Triffin dilemma and all these things with the working class getting hollowed out. And I love what you're saying, because I doubt there's many people that want to get in line to run this same experiment on their fiat currency, seeing a lot of the negatives play out for the United States right now.
Yeah. Also, there's not going to be a superpower after this, it seems. There's, like you said, this is a transition into a multipolar world. And without somebody able to put a gun to your head and force you to take this fiat currency that they would like, there's not really any way to pull that off. Also, as a joke, like we could also just try the opium on the Chinese again.
Which is crazy, right? Because the fentanyl's coming the other way, right? Where's this fentanyl coming from? I mean,
I think they're actually doing it to us is the real story.
Oh, yeah.
They are.
We see that shit. It's scary
Absolutely.
too. Yeah.
And, so and to be blunt, like, I don't think our policymakers in Washington would care that much about us all getting hollowed out. They haven't, clearly, over the last 25, 30 years. If they had, they would have changed something. However, where it's now hitting close to home, COVID, when their own kids, when their own grandkids in Congress couldn't get masks, couldn't get supplies. Why? Because it's all made in China, because we don't make this stuff anymore. When the U.S. military sits down with congressional briefings and says, yeah, I know you want to tell your constituents that we can support Israel and Ukraine. Here are the facts. We can't. We literally don't have the industrial capacity to support these two wars, which you are increasingly seeing. And oh, by the way, this doesn't even apply to Taiwan. That is hitting home in Washington in a way that is, for anyone that's been in sort of the middle and working classes in middle America for the last 25 years, is like, well, yeah, duh. But things were so good in Washington and on Wall Street, it didn't matter. Well, now it's really starting to matter that it is a threat to U.S. national security, to the credibility of defense readiness. When you have the CEO of Raytheon get quoted in the FT saying, we can't fight a war without Chinese rare earths, and it will take us years to get there. And we aren't the only ones in that position. That is ultimately a currency system issue. That's the dollar. That's what the dollar did. You love the dollar, great. That's the side effect. And increasingly, like I know because I'm talking to the people saying it, that is now understood in Washington. That is now understood at a policy level in this country in a way that was much more ephemeral. They Triffin dilemma. Okay, explain to me what that is. But Triffin dilemma, nobody gives a crap about Triffin dilemma. I can't get masks for my kids and my
Yeah.
grandkids, and I can't get shells for my military. That they understand. They understand at a very tangible level, and we're there. So there's a willingness to allow this system to change amongst officialdom in Washington that has not existed in a long time for very, again, pragmatic, realpolitik reasons.
Folks, when a fellow firefighter, family member, or friend asks us where we buy Bitcoin, we point them to Swan. It's the place Josh and I have dollar cost averaged into Bitcoin for years. At Swan Bitcoin, you can set up automated Bitcoin savings plans as well as execute instant purchases. They serve clients of any size, from firefighters to institutional investors, and an account is startlingly easy to set up. I've watched a fireman do it on a smartphone while sitting in a recliner in less than 7 minutes. Swan also offers Bitcoin IRAs. You can start or roll over a traditional or Roth IRA with enterprise-grade custody, attentive service, easy onboarding, and transparent fees. And visit swan.com for details on everything that Swan offers. Ladies and gents, the fact is that Bitcoin remains decentralized because its ledger is distributed all across the globe. The thousands of computers that keep track of who owns what and ensure the accuracy of the Bitcoin blockchain are the nodes. You ought to be verifying your own transactions and balances, as well as enforcing the consensus rules yourself. The software and hardware we use to run Bitcoin nodes is StartOS by Start9 Labs. With StartOS, you can fire up a full Bitcoin node in a very easy plug-and-play fashion, but you can also do way more. Start9 gives you optional capabilities to run a full-blown private server, allowing you to easily and incrementally level up and opt out of today's increasingly centralized and alarmingly censored cloud computing model. Just as Windows and Mac OS made it possible for anyone to run their own personal computer, StartOS makes it possible for anyone to have their own personal server. Run a Bitcoin node, run a Lightning node, run a NOSTR relay, control your own photos, videos, and messages, and much more. Check it all out at start9.com. Right. You also hollow out practical skill sets. Like, this is an oversimplification, but peak cheap money means peak artificial money means peak artificial workforce. And there's a lot, many jobs that are incredibly important where people sit behind computers. But as Jimmy Song, who's a Bitcoiner, has said, there's a lot of MBAs making Excel spreadsheets that no one gives a fuck about. And there's a huge deficiency in people doing the real stuff. And that's coming to a head right now. And especially as money gets tighter, a lot of that is going to be exposed in a way that's already proven to be uncomfortable, and I think will be increasingly so. And as we move into this new system, I think there's a chance, or at least one working thesis we have, is that highly skilled, important labor may get better compensated over the next decade or two if you're in the right space and you're willing to do the uncomfortable. Because everybody wants to sit in their fucking basement in their slippers right now, which is great if you can do that, but the market's going to kind of turn another way, yeah. I think.
%. And like, it's an advantage. Most people wouldn't say being in Cleveland and doing macro is an advantage. And I think for this moment in time, it actually is, because, when I talk to the 70-year-old who's been in the trades his whole life and just sold his business and can't find people, and I listen to an economist in the coast say, well, wage inflation's done. And look, can you get wage inflation down tactically? Can you take rates high enough and create some unemployment amongst sort of, a spreadsheet class of which I am a part? Sure. However, like, when you can't get the part, and again, so much of the working class skilled trades class is age 55 to 70.
Yes.
And most of them have a decent little nest egg in the bank, and they're close to retirement, and they don't want to deal with the ass ache. And so, again, like so much else the Fed and policymakers have done, it's penny wise, pound foolish. You, in attempting to fight inflation by increasing unemployment, what you're actually doing, you're going to make inflation a little bit better for the moment, and what you're going to get on the back end is face peeling inflation in the skilled trades. and shortages, flat out shortages.
Yeah.
People, it just, I mean, God, I saw snowplows. I mean, people were getting paid $175 an hour for snowplows last year, and they couldn't find anyone to do it.
Yeah, we see that too. We see very few people signing up to be firefighters as compared to 10 years ago. It's like a 10th or a 20th of what it was. I have one last question for you. I'm sure Dan's got at least one more, but this one is something I've been wondering, especially from your perspective. A couple years ago, people said the Fed can't raise rates beyond a certain level because it'll just break. Things just won't make it. Well, we've sat here and watched for the last 2 years as they did just that, and things have been shuffling along for the most part, besides the SVB bank blow up in March. What is it that you think is going on now that people aren't paying attention to, or they have a view of that they think that just can't happen, where it not only can happen but potentially will happen? That is just far outside of the window of most people's thinking of a possibility.
Yeah, I was one of those people. I mean, I was saying, they're not gonna, and they can't. And that view was really based on they're going to create dysfunction in the treasury market. And to be clear, they created dysfunction in the treasury and gilt market last September. And they came in and treasury weakened the dollar by running down TGA. And then they did it again in March with the banks. And they did BTFP and this sort of, this is not QE,
right.
Behind the woman behind the curtain. And then they just did it again. We just had, more treasury dysfunction. And so far, sort of, there's been some liquidity metrics that have seen some uptick in the last week. I don't know where the money's coming from, but, I've got some friends across Wall Street that are like, I don't know where the money's coming from, but there's some signs here that there's some liquidity coming. I don't know from where. I don't know how long it'll last. We'll see. So the treasury dysfunction that I expected to happen as they raise the rates happened. They've done a great job of managing kind of this process. The stock market decline that I expected to happen when they did it happened last year in particular. The receipts impact that I expected to happen as a result of the rise in rates and the decline in the stock market happened. This whole, in the last month and a half, you've had sort of officialdom economics, Washington Post, New York Times, Wall Street Journal, Financial Times. Oh gosh, where are these deficits? These deficits are enormous. They're up enormously. Where are these coming from? It was kind of like, this is exactly what I said was going to happen 18 months ago. You're going to send your receipts up, or your interest up, your receipts down. It's happening. But we haven't had sort of the big bang moment of the thing that people aren't watching or expecting to happen. So they are slowing the economy, the private side. They're increasing the deficit. The government doesn't make anything, right? They're just growing emissions. The private side that needs to make stuff to address the government spending, it's basically the same thing as COVID. So the government's spending more and the private side's putting out less. We don't know, what did that lead to in 21? A lot of inflation. And so I think that is the dynamic that people aren't seeing that could sneak up on them, which is, we've had 3 straight months of sequential uptick in inflation. And there's sort of some of it's comparisons, some of it's just, maybe it's nothing. I don't think it's nothing. I think it's going to continue. Even if things kind of keep weakening. Number one, that's going to surprise people. And then number two, unless they weaken the dollar meaningfully, you're going to this machinery of the net international investment position being as high as it is, how much of it being treasuries, the foreign debt position, so much of it in dollars, creates this vortex where that's the surprise I think that's coming, which is if they keep tightening with deficits this high, long end of the curve is going to keep rising. And if they come in with more dollar liquidity to weaken the dollar, to sort of contain the long end of the curve, they'll buy themselves a little bit of time. You could get a bid for treasuries, the long end of the treasury, whatever. But ultimately, that's going to show up in a couple of months in the inflation metrics. And that's going to cause them to lose the end of the long end of the curve. So that to me is the side that don't feel like is very, very well appreciated, which is because the debt and the net international investment position is so big and negative, and the debt's so big, and the deficits are so big and so structural, and the offshore debt position for dollars for foreigners is so big. There was always a moment that was going to come where if they don't tighten, they lose the long end. And if they do tighten, they lose the long end. And like, that is the moment.
Yeah.
And that we're not there yet, but you can see there from here. And that is where I think people are not appropriately factoring. And then the second derivative of that, which is, I don't know what the rate is, but at like 8%, 7%, maybe, probably close to 8 or 9%. Forget about defense and forget about entitlements.
Yeah.
An 8 or 9% rate, maybe it's 7, I don't know, because you have to make some assumptions around the convexity of the decline in receipts and what is a highly financialized economy. And that will be very nonlinear, right? So 20% of the economy is finance, insurance, real estate, fire. That's not a sector at 7% that just goes linear. That's like commercial real estate is friggin', down 80%. That's how that goes. We saw that in a way. So if 20% of GDP goes down 80% quickly, now your receipts are going to be down, right? So there's a world where very quickly 7%, 8%, 9% rates, and I think it's, I don't know what that number is, but there's a world where all of a sudden, forget about defense, forget about entitlements, just interest expense is above receipts. And when your interest expense is above your receipts, markets are forward looking, so it won't have to happen, but it'll be pro forma. They have a word for that when you have to print the VIG, when you have to print the interest. It's called hyperinflation.
Yeah.
And I'm not saying the U.S. is going to hyperinflate, but I do think the base case for the U.S. is our U.S. with, Argentina with U.S. characteristics. That is the secondary sort of the derivative, right? This was the whole, it's, I said to my wife the other day, it's this really interesting moment in time because we're in this forever, like, Luke, you're crazy. There's not going to be a treasury problem. The treasury, they're not, rates aren't going to, okay. And now we're into this, the deficits did blow out. The treasury market is dysfunctioning. So what? And it reminds me so much of like the 04-05 timeframe where, they would say in The Big Short, you're crazy. Home prices could never fall nationally. And then there was this moment of time, it was like, okay, they are falling nationally. So what? And the time from that to like, it was like, tick, 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 boom. And we're now in the, okay, so the debt does matter. Everyone in Washington, okay, the debt matters. Paul Krugman is saying we probably need to cut the deficit, but we probably won't. Like Paul friggin' Krugman, Mr. The deficit never matters as long as my team's in the White House, rah, rah, rah. He's even admitting it. That's okay, so home prices are falling nationally, so what? And the second derivative of this version of this iteration is oh shit, interest is 70, 80%. You can't own bonds in that. They're not going to default on the debt. They're going to print the money. They're not going to cut the defense. They're going to print So that's, to me, the part that's the second derivative of, okay, fine, the interest or the debt does matter this time. That's the part where I think it's going to smack people upside the head. I think it's really good for gold. I think it's really good for Bitcoin. I think it's probably good for stocks too, to be honest.
Right. Totally. Man, like, I think this is where I double back to something I said earlier of it's as though people know they're in the pot. They know that the burner's on and they're kind of watching themselves get boiled alive. Like this is where I encourage people to stay vigilant. These things don't happen in 3 months, right? And another analogy we could draw is like the emperor is stripping down, like he's taking off his clothes. Eventually you will see his cock. Like you're going to see private part, you're going to see private parts. Like the trend is going this direction. Right. And I just encourage people, like, please keep this on your radar. Just because you've heard, maybe you found economics through Bitcoin and you're like, I'm sick of these macro discussions on these podcasts. They're boring. I don't understand what people are saying. You got to keep listening to the Lou Gromans of the world because this trend is not reversing. It's escalating and the dots are being connected in the exact ways that are anticipated And, as people like Larry Lepard and Greg Foss and Preston Pish and other Bitcoiners say, like, that there's no, like, this is mathematically assured in some sense that this is going to be uncomfortable. We'll end quickly here. You've been super generous with your time, but just as a closer to draw this back to our mantra, if you are that tradesman in Cleveland, you're a retired middle school teacher living on a pension, you're a firefighter, you're an engineer with a 401k you're relying on, what is just your closing, overwhelmingly simple statement to that person of how they protect themselves from this devolving spiral? How does this get practical?
Yeah, I think it's just important to to understand that we're in for a period, very likely a period of years of sustained elevated inflation that probably ebbs and flows, higher highs and higher lows over the next 5 to 8 years. And not to be afraid and panicked about it. It's something I've found. It's a uniquely American trait that when you talk about these things, Americans go straight to, oh, well, it's zombie apocalypse and I need, like multiple shotguns and spam and
yeah.
Like, no, like this stuff happens with startling regularity around the world to sort of everybody else. It just hasn't happened here in a very long time. And so if for the average person concerned about their financial future, it's take 10, 15% of your assets, put, 10% in gold, 5% in Bitcoin, and then don't really change anything else. I don't think I would take that 15% out of long-term debt. Whatever long-term bond fund you own, take 15% of your total assets, take it all out of long-term bonds, and put 10% in physical gold, and put 5% in Bitcoin, and then go live your life. You're going to be fine. This isn't about trying to become the next Ray Dalio, and so much on Twitter is to trade this, trade that. There's no trading this. Like most of the pros, myself included, aren't going to be able to trade this. And the average person is going to have no chance on trying to trade this. This is just about,
Amen.
Totally agree.
Have a fire insurance policy in place, have the firefighters on speed dial, and when the fire breaks out, don't throw water on a grease fire, and just have 10% physical gold, 5% Bitcoin. You're going to be fine. And if you lose 15, say those two things go to zero. No, by the way, gold has never gone to zero in 5,000 years of history, but say they both go to zero, you're down 15% of your assets. Who cares? The good news is that means you're the rest of the bonds that you own in short term are going to be up in real terms. It's all about just having a balanced perspective in a way that unfortunately most financial advisors aren't going to have. It's mostly 60-40, 60% equities, 40% bonds, or vice versa. You haven't had to think about the currency in America for 50 years, 45 years. And you need to think about the currency. And it is what it is. You just go live your life.
Yeah, that emperor has got some doting eyes. You got to get yourself ready before those panties drop.
Yeah. And the last thing I'll chime in with, I'm sure you'd resonate with, Luke, is develop a marketable skill set that's going to stand the test of time, right? Keep your cash flow free, your skill set marketable, take some hedges against the fiat Ponzi, and don't live in fear. I think that's another great message. Raise a family, play some golf. Don't freak out every second, but stay vigilant, because we are in a different couple decades than the last few. No doubt about it.
And look for rule changes. Right? Just the rules do change on you, right? So there's how can you hedge those rule changes of hey, I've got a bunch of rentals. Okay, well, what happens if that municipality says, you know what, your property taxes are up 100%.
Right. Rent controls.
Right. Rent controls. Now, you just stress test, if you have a lot of exposure to one area, it's not the time to have a whole ton of exposure to one area, whatever that area is. I love Bitcoin, but I've also highlighted to people structure your size in Bitcoin, in gold, to a world that existed from 1933 to 1974, which was Gold was illegal for 40 years for Americans to own. Did they come and take it from you? Not really. Could you sell it easily? No. What would happen if for the next 30 years they say you're not going to be able to get in and out of the on-ramps very easily without going without being made a criminal, by moving through the lightning network, to move something. What if that happens? Do I think it's going to happen? No, I hope it doesn't. But we're into a world where you have to consider it could.
When that kind of stuff,
fat tail.
That's when the state shows its teeth, when things get sideways. So just be prepared.
It's very dangerous to be right when powerful men are wrong. I think it was either Montesquieu or it wasn't Lafayette. At any rate, it's a famous quote. It's very dangerous to be right when powerful men are wrong. And powerful men are wrong, right? It's Will Rogers. It's almost been worth this depression to see how little our big men know. That's where we are. So you have to be balanced, I think, across not too much debt, not too little debt. Fixed it out, term it out if you have a mortgage at the lowest rate as possible, as long as possible. You want to be balanced. It's going to be very, very hard to trade through this. This isn't about, maximizing money. This is about, getting through and living life.
Great advice.
Thanks for your generosity with your time this morning, Luke. Hand off to you and your work for our audience as you leave.
Oh, sure. Thanks. More information about our product. We've got mass market products and institutional products, FFTT LLC.com. And as you guys know, I've got a pretty active Twitter feed at Luke Gromen, LUKEGROMEN.
Thanks, Luke. Appreciate you, man.
Yep.
Thanks
for having me on, guys. Great chatting again.
Our pleasure.